In this video, I'm going to explain how to use the 10 most popular trading indicators and show you how you can use them to trade smarter, all in 10 minutes, thereabouts. For all these examples, I'm going to be using the chart in TradingView, and this is going to be a fairly quick-fire overview just to give you an idea of how each one works so you can decide which ones you reckon suit your trading style. And if there are any of these indicators that you'd like to see me dedicate a whole video to, then let me know in the comments. So without further ado, let's get straight into it. A moving average smooths out price information by creating a line on the chart that constantly updates the average price over a certain period of time. This can really help to identify the overall trend direction by filtering out short-term price fluctuations. A simple moving average, SMA, gives equal weight across the average, while the exponential moving average, EMA, gives more weight to recent prices, making it faster to react. It's common to use two moving averages together, and a popular setup would be to use a 9 EMA with a 21 EMA for scalping. You want to look for when the lines cross over each other for a signal of a trend reversal, or if the price pulls back to the line, that could be a good time to place an entry. A 200 EMA can be used to check whether the price is currently in an up or down trend. This is good for longer term traders where you don't want to trade against the trend. If the price is above the 200 EMA, then the market is in an uptrend, and if the price is below the 200 EMA, then the market is in a downtrend. The RSI is a momentum indicator that measures how fast and how strong the price moves over a recent period. It can spot when a stock is overbought or oversold and can help to time entries, exits, or to confirm trends. Think of it like a speedometer, showing when the market is running too hot or too cold. Now, the general consensus is that if this purple line breaks above 70, then this stock is considered to be overbought, and we could see a pullback. If the line breaks beneath 30, then the stock would be considered oversold, and we could see a bounce. Now, this yellow line here is a moving average of the RSI. When the purple RSI line crosses over the yellow moving average line, this could indicate a new trend breaking out, and we can see on the chart that the price then rallied. Shortly after, the stock was overbought here, so you can wait for it to return back through the 70 mark, and when it crosses the moving average, that's a good time to go short. Remember, just because the RSI tells you something is overbought or oversold, doesn't necessarily mean that it is, so don't take it on face value. A good idea is to combine the RSI with the moving average setup as explained earlier, for extra confirmation on trends and support and resistance. The MACD is a trend and momentum indicator that shows the relationship between two moving averages and can generate buy or sell signals when the MACD line crosses above or below the signal line. When the blue MACD line crosses above the red signal line, that's a bullish crossover, but only when it's below this baseline here. And you'll notice the histogram, these bars here, start turning positive too, showing that the momentum is shifting in the favor of the buyers. And shortly after, you can see that the price starts to rally. When the blue MACD line crosses below the red signal line, that's a bearish crossover, but only when it's above the baseline. Bollinger Bands are a volatility indicator that plot three lines: a middle line, which is usually a 20-period moving average, and an upper band and lower band that expand or contract based on market volatility. When the bands are wide apart, the market is showing signs of volatility. When they're tight together, the volatility is low. The classic Bollinger Band squeeze strategy is where you look for periods where the bands are tight together and the middle SMA line is fairly flat. This signals low volatility and a potential big move could be coming. So watch out for a breakout above the upper band, which is a bullish signal, or a breakout below the lower band, which is bearish. Again, it's always a good idea to combine this with other indicators to confirm the breakout strength and probability. The Fibonacci Retracement is a tool that helps to spot potential areas where the price might pull back to before continuing with the trend. It works by plotting horizontal lines on the chart starting from a chosen point, and these lines are percentages based on the Fibonacci sequence, which is a naturally occurring sequence that we see in maths and in nature, and it's widely believed that markets often breathe in these similar patterns. So first of all, we look at the structure of the market and we find where a new trend has started. Then we click on the Fibonacci retracement tool here, and from this lowest point, we click and drag all the way to the highest swing point. 38.2% and 61.8% are the most watched levels. 50% isn't actually a Fibonacci number, but it's commonly used because the price often retraces halfway. These levels act like support and resistance zones, and you could expect the price to bounce, stay, or reverse at these points. So after a strong uptrend, wait for a pullback to one of these lines to go long. You can combine this with the RSI to look for divergence, which will give us a strong indication of a big move to come. Such as here, we see that the price has touched and retouched the red 23% Fibonacci line, and on the RSI, it's actually made a much higher high at this point, telling us that this is bullish and possibly a good time to go long. And we can see shortly after that the price did start to rally. The stochastic oscillator is a momentum indicator that compares a stock's closing price to its price range over a set period. Now this is more sensitive than an RSI, so it's a good indicator for fast markets. This blue line is the K percentage and this orange line is the D percentage, and these lines move between 0 and 100, helping to spot overbought and oversold conditions. When the lines cross above 20, it's a potential buy, and across below 80 is a potential sell. So a good strategy is to wait until the lines are in the oversold zone, which is below 20, then look for when the K line crosses above the D line. Now when this happens, wait until they move back above 20 before placing your trade. For a sell, you do the opposite, so wait until the lines are in the overbought zone, which is above 80, then look for when the K line crosses below the D line. When this happens, wait until they move back below 80 before placing your trade. Now again, you can add a 200 EMA to the chart to really help confirm this strategy by making sure that you're not trading against the trend. So when the stochastic is showing oversold and you plan to go long, check the 200 EMA to make sure that the price is above it, signaling the market is in an uptrend. And when the stochastic is showing overbought and you plan to go short, check the 200 EMA to make sure the price is below it, signaling that the market is in a downtrend. The ATR is one of my favorites. It's an incredibly helpful volatility indicator that tells you how much an asset moves on average over a specific period, and you use the ATR to help you determine where to set your stop loss based on the expected market movement. So instead of just guessing where to put your stop loss, you can use the ATR to give you an idea of the natural movement of the stock in order to place it smartly. The ATR default is 14 periods, so on an hourly time frame it calculates the average price range of the last 14 hours. And if you're on the 1 minute time frame, it calculates the average price range of the last 14 minutes. And the number in the corner here is the current ATR. So on this 5 minute chart, at 3 p.m. the ATR is $1.78. This means that the stock has moved $1.78 up and down on average over the past hour or so. If you enter a buy trade of $100 at this point and you set your stop loss at something like 50 cents below your entry, then as you can see, you'll just get stopped out by the natural movement of the price. So a smarter way to set your stop is to look at the current ATR value and use that number as your stop instead. So the current price is $590 and the current ATR is $1.78. So I'll minus 178 from 590, which gives us $588.22. And that's where I'll place the stop instead. And as you can see, putting the stop here is tight enough to protect us if the trade goes the wrong way, but far enough away to not get stopped out before the price starts to go up. Putting the stop here respects the stock's normal breathing room, but still protects you if it really moves against you. Parabolic SAR is a trend-following indicator that shows potential reversal in the market. It appears as dots above or below the price. Dots below the price suggest an uptrend, and dots above the price suggest a downtrend. And when the dots flip sides, it signals a possible trend reversal. So this is good for timing entries or exits. For scalping, wait for a dot flip where dots move from above to below the price and enter in the new trend direction for quick moves. For swing traders, you want to stay in a trade as long as the dots stay on the same side and only exit when the dots flip to the opposite side. To help avoid false signals, add a 200 EMA to make sure you're not trading against the trend. It's a really simple visual way to ride trends and catch quick reversals without overthinking it. The volume oscillator shows how many shares are traded during the time frame of your chart, and this can help gauge the strength or weakness of a price movement. High volume means that there is a strong interest and can confirm price moves, and low volume suggests weak interest and can signal a lack of conviction. Spikes in volume often occur at breakouts, reversals, or during news events, but remember, the volume indicator does not indicate the direction of a trend, it just tells us the strength of the momentum. By analysing the volume together with the candles, you can assess the strength of the trend. So a price increase accompanied by high volume could indicate a strong upward trend, while a price increase during low volume could suggest a weaker trend. Now this indicator does not work with Forex, so only use this for stocks. A good rule of thumb is that when there is a breakout with low volume, you should be skeptical. But if there is a breakout with high volume, it could be a good time to place an entry. Pivot points are used to identify potential support and resistance levels and are calculated from the previous day's high, low, and closing prices. The main pivot point level is this line on the chart, which is calculated from yesterday's high, low, and close price divided by 3. The other lines here are support levels and resistance levels, and they are calculated based off of the main pivot level. These are labelled S1 and 2 and R1 and 2. If you see more lines on the chart, then you can turn these off in the settings, as I find that 2 levels are enough, as the price usually stays between R1 and S1. If the price breaks above the pivot line, then that is considered to be bullish. And if the price breaks below the pivot line, then that's considered to be bearish. Now many traders use pivot points and are all therefore using the same levels of support and resistance, placing buy and sell orders in the same places as everybody else, creating a lot of supply and demand in these areas. So this is a very useful tool to have. So there you go, 10 of the most commonly used trading indicators explained in roughly 10 minutes. Remember that this is just a quick overview of each one, and it's now up to you to try them out in demo mode to really see how they work and whether or not they're right for your trading style. If you'd like me to go into more depth with any of these indicators, then let me know in the comments and I'll dedicate a whole video to the ones that most of you ask for. But for now, thanks for watching. If you found this video helpful, please consider subscribing to the channel. Best of luck, and I'll see you next time right here on MAFFMARKET.